Hi, this is Sue again, and this is going to be slightly different. It's a review. Some of you can just skip this if you'd like to, watch it, that's fine. I've had a request from a family member who has a neighbor that's hearing impaired, and they've asked me to do this, and I thought about it and I thought, well, this would be good not only for someone who's hearing impaired, but it would also be good for someone who is not a native English speaker. So I'm going to speak a little bit more slowly, and I'm going to take my time, give everybody time to read the screens. What we teach here is trading price patterns using the MACD divergence, the 8 and 21 EMAs, but with confirmation. And I really want to hammer that home because it's the confirmation piece that reduces your risk. Okay? This trading approach is simple, but it's not necessarily easy. It follows along the Occam's razor theory of the simplest way to do something or the simplest answer until proven wrong is usually the best answer. And that's this methodology. When I first saw this, Occam's razor came to my mind. So without further ado, the way to start out is to make 6 agreements with yourself. Sometimes I do 8, sometimes I combine them into 6. This is an older PowerPoint. It had a lot of text on it, so I used this as the foundation for this presentation. When you're starting out, don't mix, blend, or bias this methodology with any other strategy. Keep your charts clean and simple and do your homework and make sure that you don't just use this on top of what you're already using. The thing about this methodology is that it is a standalone. Once you learn it, then you can throw it away and apply it in your other world. But you can't learn to do this and trust it when you're layering it on top of something else. Okay? I've never had anybody succeed at that. While learning, you have to make an agreement with yourself that the MACD2 line leads price. Now that's hard, but no matter what, this is the truth and you've got to trust it. And this is one of the reasons why we ask you to trade in paper. It gives you the time without the stress of risking your capital to learn to trust this. You won't trust it until you've seen it over and over and over. And it takes a little finesse to, accept that this can be this straightforward. Longer term charts have more power to attract price. We've talked about that before. When a pattern sets up on a monthly or weekly chart, it has taken a long time to develop. So the likelihood is if you are directionally against the monthly and weekly strength and the market shifts on you, it is very likely if you are directionally incorrect that that snapback will be very expensive. So take into consideration when you're putting trades on the longer term charts and the magnetic power they have to attract price quickly. Now, having said that, the shorter term charts feed or starve the longer term charts. So in other words, no matter how strong those monthly and weekly charts are, if all the lower time frames turn against them and don't feed them any longer, eventually the higher time frames will erode and weaken, correct? It's like, a river changing direction. If the river, hits a blockage and shifts its direction, whatever was being fed by the river before is no longer being fed by the river. So it'll starve out that area. By the same token, if you remove the blockage and actually all the blockage upstream, the flow coming in will feed those higher time frames even faster. So if everything turns in the direction of the higher time frames, all the lower ones, it'll feed that higher time frame. If it turns against it, it will starve it. So change happens on the shorter term charts. But the attraction for price is strongest on the higher time frames. But change starts down on even just the 1 minute chart. Okay? Change of direction, change of tone. Next. When you're looking at price, you want to look at it only in relationship to the MACD. That's primary. So when we're talking about these charts, we're going to be looking at the MACD, then at price, then at the MACD, then at price, price and the MACD. We're going back and forth to draw those lines in. So just remember that you're only using price in relationship to the MACD to establish whether or not there's a divergence. You can look at the general market and see what it's saying, but while you're doing this, the relationship between price and the MACD is essential. Okay? While learning paper trade, I would only trade real money on a classically defined pattern on a longer term chart. We'll see some of those in this series. And golden eggs only. In children's stories, we tell the story of the goose that laid the golden egg. Well, you really only want the golden eggs. If you had a bunch of eggs on the ground and some of them were golden, you wouldn't want to run around picking up all the other normal eggs. You'd just be looking for the golden ones as quickly as you could find them, right? So keep that in mind. Golden eggs only. Don't overtrade. Don't just try to take every trade that comes along. Try to stay focused on one trade at a time while you're learning and slow everything down. Okay? Now remember, this is momentum trading, especially in shorter term trading where you're trying to short-term trade, day trade, or you're trying to catch a reversal, you're watching for a reversal. We really want these entries to be at a place where you're getting a blast off underneath you or above you if it's a short. What we want is we want you to be green in the money quickly. We want you to have profit so that the trade feels more comfortable. And because this is momentum trading and we're really focused on a clean, nice entry, you've got to be organized, folks. You've got to be organized. You've got to get your lines in advance. You want to be checking on them, whether you use a whiteboard in your office like I do, or you use a notepad, or you use an electronic spreadsheet. However you do it, you want to check up on these and follow up on these. Okay? You've got to be organized. You can't set all this up and then, oh gosh, I forgot to check and there it went without me. Okay? So it's the blast off that comes from a very specific setup. That's particularly true of the reversal patterns. And then trade just a few stocks at first and trade less frequently. You're going to be amazed if you shorten your watch list down. You'll notice that my watch list never has more than 18 names in it. And very often I'm only trading or looking at about 4 of them. You're going to find that the more you focus in on a shorter list, the more you learn and the faster you learn it because you're actually paying attention to something. You can actually see what you're doing and think about it. You have time. When you're chasing everything that moves and, oh, somebody saw that, did you see Under Armour? Did you see Chesapeake? Did you see this? Did you see that? Well, you won't learn as well. So slow down. Trade less frequently and trade a shorter list. Watch a shorter list. And then the reason for the lines, my friends all tease me about the pink lines. The reason that we spend so much time setting those lines up is because once we get the lines in, then we wait for the trades to come to us. They either set up or they don't. But we're no longer out scouting for a trade. We're waiting for the trade to come to me. Okay? That's the purpose of the pink lines. It helps you stay very, very organized. In reality, the way I frame this out is you have to first know what the monthly, weekly, and daily charts are saying. Where is your proposed trade most strongly supported? And this is true even if you're day trading. So in other words, are you trying to swing trade against a weekly setup, against it. Well, if you are, you better have support from the monthly, and the daily better be dynamite. You've got to know where your support is on this trade. Even if you're day trading, I like to trade in the same direction as the weekly and daily setups, where the daily and weekly power is. Okay? I don't have to, but it's so much simpler. The MACD should signal first. So when you think about it, once you're looking at something, the MACD should be blue line above or below red line. It should be the fast line above or below the slow line. We're going to get into that. That's in your chart setups, video number 1 and 2. And it signals first that, you know what, something's happening here. Get ready. So we do a get ready right there. The 8 EMA should cross the 21 EMA. If they've already crossed, then there should be a squeeze of them coming together, or there should be a curve, a shovel scoop for an up and an inverted shovel scoop for a down. When this happens, we call this the get set. So the MACD is get ready, the 8 and the 21 are get set. And then whether you go or don't go, very often I let that be determined by whether or not the market will support my entry at that moment. In other words, if everything is set up and aligned for a long, but the market is dramatically down that day, I might wait a day. I might back off at least a half a day. I might really rethink everything. You know, am I just looking really strong right now? What would it take to make this not look so good? Okay, because if the market continues against me, you know, chances are it's going to impact my profitability. So make sure that the market's going to support your entry, and that's when you decide go or don't go. Okay? This is part 1. There will be at least 1 or 2 more parts here. There'll be a second part of text, and then there'll be a third part where we'll look at some current charts. Okay? Because this methodology is so visual, that should be very helpful. Thank you. See you in part 2.